It's time to put the eye on the economy. That's with Shireen Darmalingham. She's Macroeconomic Strategist over at Standard Bank. Shireen, thanks so much for joining us this morning. Let's take a quick look back at some of the data that came through in yesterday's session. First, of course, we had business confidence index numbers being released. Run us through what you've made of those numbers and how you've interpreted them.
Yes, Alishia, we had the business confidence data coming out for the final quarter yesterday. The number came in at 46 points from 47 points in the previous quarter. While it was just a slight dip, we had expected that there would be a deeper dip in confidence on the back of what has happened in the labour market and with the social unrest going on there. So we had expected that it would have impacted on business sentiment a little bit more than what actually came through. Having said that, there was still quite a significant pessimism with regards to the building contractors and the manufacturing sectors, which is all still in very negative territory, or rather very pessimistic territory, with those numbers remaining well below the 50 benchmark level. We did see some increases coming through from the other sectors, from wholesale, trade and retailers as well, but we did see with regards to motor dealers that there is some negative sentiment coming through, and that could possibly impact on our GDP numbers as well. The business confidence data is sort of like a coincident indicator for gross fixed capital formation, and with the numbers remaining well below the 50 benchmark level, we are expecting some softer numbers coming through for fixed capital formation. We are expecting GDP to still come in below the 3% level at 2.5%, but we still expect that the downside risks to our GDP number are growing.
Shireen, your colleague Kevin Lings, always your partial colleague at StanLib, he said we might have expected worse given the labour issues in particular, and the way he described it was, he said this is not, as you say, it's an indicator of the BCI, not indicating recession but an economy that's lost momentum.
Yes, indeed, David, we do agree with that statement. We do believe that the economy has lost significant momentum, and we can see that coming through from the manufacturing and the mining sectors, which showed very significant declines in the third quarter of this year, with the mining sector considerably going to impact on the GDP numbers. In fact, we are expecting the mining sector to possibly subtract about 0.6 percentage points from the total GDP number. So it is going to act as a significant drag in the third and fourth quarters and going into the new year. So we do see that loss of momentum continuing into 2013.
So with that waning momentum coming through on the GDP front, Shireen, what's your outlook for interest rate decision come tomorrow? Of course, we've got the MPC making that announcement tomorrow, and expectations by and large is that we're going to see rates remain flat for now. Are you in line with consensus?
Yes, Alishia, we are in line with consensus. We do believe that the SARB is going to keep rates at 5%, but we do believe that the SARB is going to want to cut rates, but they're not at the point at this stage to cut rates in November. We do expect them to possibly lower their GDP forecast, which they did at the last MPC's meeting, but we're also expecting the CPI forecast to be pushed up, as well as the current account deficit to widen, their forecast to widen. They had mentioned that the current account numbers is an additional factor that they're considering, and with the widening of the trade balance, we don't expect them to move rates at this point. We do expect some kind of easing to happen. It might not happen at the beginning of next year, and we possibly could see easing happen later rather than sooner.
And then, Shireen, we've got the CPI numbers out, obviously related to what you've been talking about. What are you expecting there?
Well, CPI numbers for October are expected later at about 10 o'clock. We are expecting some moderation in the CPI number to about 5.4% year on year, which is in line with consensus, and this is from 5.5% year on year in September. We do expect that food prices are possibly going to alleviate some of the pressure on the overall CPI basket, with the number possibly coming in below the 6.1% year on year, which we saw in September. But having said that, we do still expect some upward price pressures to emanate from the transport component, particularly the petrol prices, which we saw increase by 21 cents per litre during the month. In November, we do expect some alleviation from that component with a 10 cents decline in the petrol price, but we still expect CPI to continue drifting upwards in the remainder months of this year.